Lately, it has become fashionable to debate what is, or is not, money printing by central banks. This debate is natural, due to the extreme policy nature of 2020, with massive fiscal expenditures, huge increases in central bank balance sheets, and changes in central bank inflation targets. It's important to know what is inflationary, and what isn't, and to what extent. Because people have very different understandings of how central bank policy and fiscal policy work. There have been analyst calls this year ranging from hyperinflation to deep deflation, and everything in between. The outcome has of course been somewhere in the middle as measured by CPI or PCE, with inflation that rebounded from March lows in response to policy, but neither much of an overshoot or undershoot, and still generally below long-term central bank inflation targets. Many inflation categories for the most essential and non-outsourced goods and services, however, have risen faster than the overall basket this year, and in recent years. The crux of this article is that quantitative easing on its own, and quantitative easing combined with massive fiscal deficits, are two very different situations to consider when it comes to analyzing the possibilities between inflation and deflation, and what constitutes money printing. The deflationary backdrop. Before diving into the mechanisms of money printing, it helps to set the stage. Context is key. Historically speaking, we're coming down from the apex of, and currently within the lengthy resolution process of, a long-term debt cycle, which refers to a multi-decade peak in public and private debts relative to the size of the economy and money supply. This occurs in the aftermath of when interest rates hit zero. We've been in this resolution process for the past 12 years, and the previous time before that was the two-decade period of the 1930s and 1940s where we hit the previous apex of a long-term debt cycle. Here is total debt as a percent of GDP in the United States over the past century in blue on the left axis, all debts, public and private, along with short-term interest rates in orange on the right axis. And here is total debt as a percent of the broad money supply, which shows the structural peaks of each cycle even more clearly, since policymakers have more influence over broad money supply than GDP, due to shifting monetary velocity. If we break out federal debt from non-federal debt, households, businesses, states, financial leverage, etc., we see two distinct peaks in each long-term cycle. Non-federal debt, orange line, peaks first in a commercial banking crisis, early 1930s and late 2000s, and then federal debt, blue line, peaks many years later in a sovereign debt crisis, mid-1940s and -2020s. There are a lot of deflationary forces on consumer prices in the economy. High private debt levels are deflationary, since it makes consumers and businesses financially restrained and risk-adverse. Slowing population growth and aging demographics are deflationary, since resource demand slows. Technology is deflationary, since it makes some things cheaper and better. Wealth concentration into fewer hands is deflationary, since money coalesces rather than circulates. Commodity oversupply is deflationary, since it cheapens the building blocks we use for everything else. Outsourcing is deflationary, since it lowers labor costs of goods and puts downward pressure on domestic wages. In a low-debt system, structural deflation for some of the positive reasons, such as technological improvement, would be a good thing. It means your money's purchasing power grows over time, as higher productivity from technological enhancements lowers the cost of goods or improves their quality, so you get more value for your dollar. However, in an extraordinarily high debt system, which requires a lot of central policy intervention in the first place to be able to get up that high, deflation breaks things and results in widespread defaults, because the cost of servicing debts goes up relative to cash flows. So, fiscal and monetary policymakers deliberately push back on deflationary forces with inflationary policy, especially when it gets to those extremes. And there are a few definitions or types of inflation that we can identify. Monetary inflation refers to the growth of the broad money supply, which can be calculated in a few ways but is pretty straightforward. Asset price inflation refers to bubble-like increases in the prices of financial assets, like stocks, bonds, gold, private equity, fine art, and so forth. This is a bit more subjective because valuations on assets can vary, but there are various ratios to keep track of it in a broad sense. Consumer price inflation refers to a broad rise in the prices of everyday goods and services, and people debate about how it should be measured. The government uses CPI and PCE calculations on a basket of goods, but those use various substitutions. There are alternative calculations that don't use substitutes, which generally lead to higher figures. Each household has their own unique basket of consumer goods and services that they buy. For research purposes, I calculated that my personal household consumer price inflation rate averaged about 3% per year over the past 2 years, taking into account our total purchases of non-investment goods and services. QE alone equals bank recapitalization. Going into the 2008 crisis, U.S. banks were extremely leveraged, with very low bank reserves. Large bank cash levels equaled just 3% of their assets. Blue line below, cash as a percentage of total assets, and large bank holdings of treasuries as a percentage of assets were pretty low historically as well. Red line, treasury securities as a percentage of total assets. So, leading into the financial crisis, only about 13% of their assets consisted of cash, 3%, and treasury securities, 10%. The rest of their assets were invested in loans and riskier securities. This was also at a time when household debt to GDP reached a record high, as consumers were caught up in the housing bubble. That over-leveraged bank situation hit a climax into the 2008-2009 crisis, coinciding with record-high debt to GDP among households, and was the apex of the long-term private, non-federal, debt cycle. When banks are that leveraged with very little cash reserves, even a 3% loss in assets results in insolvency. And that's what happened. The banking system as a whole hit a peak total loan charge-off rate of over 3%, and it resulted in a widespread banking crisis. However, banks were bailed out via QE and the Troubled Asset Relief Program. It was a top-down, anti-deflationary bank industry bailout, but not a bottom-up, pro-inflationary real economy bailout. TARP boosted bank solvency, and QE boosted bank liquidity. As the crisis played out and some banks failed and others were bailed out, regulators wanted to increase bank reserve requirements and capital requirements, requiring banks to hold a greater percent of their assets in cash reserves and other safe assets. The problem with that, however, is that banks can't just magically boost up their reserves. They would have to sell other assets to get cash, but if every bank in the system sells assets to get cash, who do they sell to, and where would so much cash come from to buy what they sell? In other words, while it's possible for an individual bank to boost its reserves by selling assets to raise capital, it's mechanically impossible for the entire banking industry to collectively raise its reserves industry-wide. So, in the role of lender, buyer of last resort, the Federal Reserve created new cash reserves out of thin air, gave them to the banks, and took some of their treasuries and mortgage-backed securities in return, aka quantitative easing or QE. Along with TARP, this recapitalized banks, bringing them from 3% cash as a percentage of assets at the start of 2008, to 8% by the end of 2008. The Fed did further rounds of QE through 2014 that brought banks collectively up to 15% cash levels, which brought them up to frothy levels of excess reserves. This, however, didn't result in more money chasing fewer goods and services, and therefore wasn't particularly inflationary for every prices. The money remained mostly internal to the banking system, at higher reserve levels. Broad money supply didn't increase rapidly. Many analysts that were worried about inflation missed the fact that the transmission mechanism from QE to the real economy was small, so this was mostly just a bank recapitalization process. Banks and their executives got a nice assist from the Fed and Treasury, but the broad public did not. Banks didn't lend much of the money out, nor was there a ton of creditworthy demand for them to do so, and fiscal spending didn't go around the banking channel very much either. A similar version of this played out in the 1930s, which was the previous time that interest rates hit the zero bound at the apex of a long-term private debt cycle. The banking system collapsed back then too, so policymakers devalued the dollar versus the gold peg, expanded the monetary base, and recapitalized banks during a banking holiday. This was enough to offset the deep deflation that was happening in the early 1930s, and turn it back into a reflationary trend in the mid-1930s, but not enough to cause rapid broad consumer price inflation. It was anti-deflationary, in other words, but not outright inflationary. The inflation fake-out. All told, the Fed expanded their balance sheet by about $3.5 trillion from mid-2008 to the end of 2014. They created new bank reserves to buy treasuries and mortgage-backed securities. Many folks thought this would be hyperinflationary, Weimar Republic style. So, they bid up the price of gold rather high. I'm glad they felt that way, because I sold my gold to them in 2011, during a period of very high sentiment. It's the only time I sold physical bullion. I wanted to load up on historically cheap stocks instead. Here was the gold price relative to my model, i.e. orange area way above blue line. And here were stock valuations relative to fundamentals. Of course, this QE ended up not being outright inflationary for consumer prices, for reasons described before. It was anti-deflationary, rather than outright inflationary. Along with low rates, it was somewhat inflationary for asset prices, but not most consumer prices. That's how it worked in the 1930s, too. We can put some broad numbers on it. From 2007 to 2009, there was a $11 trillion decline in U.S. household net worth, as it fell from $71 trillion to $60 trillion, due to a decline in stock and house prices. It then took about 5 years for U.S. household net worth to recover to previous highs. This was $11 trillion in deflationary wealth destruction, plus technology improvements, and commodity oversupply, tightened credit for home equity loans, and other deflationary forces, up against the response of $3.5 trillion in Fed Bank Reserve Creation or QE. Of course, it wouldn't be hyperinflationary. Morally hazardous? Sure. Hyperinflationary? No. Moreover, as previously described, most of the $3.5 trillion never entered the broad money supply because there was no major fiscal transfer mechanism, so it mostly just stayed in bank reserves. It offset a deflationary shock and bank collapse by recapitalizing the banking system with higher levels of solvency and liquidity, and thus was anti-deflationary, but it was not outright inflationary. Bank reserve example. Banks, in practice, are limited in how much leverage and risk they can take by their regulatory capital requirements. In this model, there are some very low-risk assets, like bank reserves, treasury securities, and gold, that don't count against the bank's risk level, and there are higher-risk assets, like personal loans, or corporate bonds, that do count against a bank's overall risk level. Banks need to maintain an appropriate balance of assets to avoid being considered too risk-heavy. In some regulation regimes, banks can also be constrained by reserve requirements, meaning that banks are required to have a certain percentage of deposits stored as cash reserves. Suppose that there is a regulatory rule which says that all banks must have an amount of cash equal to 5% of their customer bank deposits, which are liabilities for banks, owed to their customers, held in reserve at the Federal Reserve. So, if a bank has $100 billion in customer bank deposits held with them which are liabilities for the bank, and $110 billion in assets, and so they have $10 billion more assets than liabilities, they can put up to $105 billion of their assets into various forms, making loans, buying securities, but must hold at least $5 billion in cash reserves at their account with the Fed. Here is a reserve-constrained bank example. A bank has $100 billion in deposits, liabilities, and $110 billion in assets. Of their assets, $5 billion is in cash reserves, $20 billion is in treasuries, $10 billion is in mortgage-backed securities, and $75 billion is in other assets, personal loans, mortgage loans, corporate loans, and/or whatever else. This bank can't lend anymore, until either it collects more deposits which would also boost reserves, or sells some existing assets. It is therefore reserve constrained. It might want to lend, and has good client demand to lend money to, but it simply can't leverage itself anymore. If the Fed were to create $5 billion in brand new reserves, aka QE, and buy $5 billion of their treasuries or mortgage-backed securities, it would alleviate their reserve-constrained status, and the bank could use that $5 billion to lend more, or buy more securities. This would be economically stimulated if the bank wants to lend money, because now the bank can go ahead and lend that money, and thus create deposits somewhere in the system and increase the broad money supply. Here is a non-reserve constrained example. A bank has $100 billion in deposits, liabilities, and $110 billion in total assets. Of their assets, $15 billion is in cash reserves, $20 billion is in treasuries, $10 billion is in mortgage-backed securities, and $65 billion is in other assets. This bank has $10 billion in excess reserves above the $5 billion requirement. Extra money it can lend. Maybe it doesn't want to lend right now, it doesn't see any good risk-adjusted loans to make. Or maybe there isn't a lot of demand from its clients to borrow money. So, it's just holding that extra $10 billion as excess reserves, in addition to their $5 billion required reserves. If the Fed were to do QE and buy $5 billion of their treasuries, and bring the bank up to $20 billion in reserves, it won't affect how much they lend, because they weren't reserve constrained to begin with. This would not be stimulative and would not increase the broad money supply, since it doesn't coerce the bank to make any more loans. That is why QE alone isn't inflationary. Increasing bank reserves does not necessarily increase the broad money supply. A rapidly increasing broad money supply along with constraints on the supply of goods and services, is what can lead to inflation. There are two ways to increase broad money supply. Either banks need to lend, or the federal government can go around them and run big fiscal deficits. At the apex of a long-term debt cycle, the latter tends to happen. QE plus fiscal stimulus equals money printing. Now in 2020, in the next recession 12 years after the 2008 banking crisis, we're back at it and bigger than before, but with a twist. This time, going into the crisis, the banking system was already well capitalized. The percent of bank assets that consist of cash and treasuries was already historically high. So, unlike 2008, banks weren't over-leveraged. However, the broader economy was over-leveraged, and the pandemic hit the broader economy. Millions of people became unemployed, and countless businesses faced insolvency risk as their cash flows collapsed. For the Fed to simply buy treasuries and MBS from banks wouldn't do almost anything for this, because it's not a bank recapitalization issue, and there would be no transmission mechanism to the public. Banks were already well capitalized, and so the banks weren't reserve constrained. Instead, this time fiscal authorities, Congress and the President spent trillions of dollars into the real non-bank economy, sending folks stimulus checks, boosting unemployment benefits by an extra $600 per week, which is $2,400 per month for several months for folks who received it. Financing banks to give small businesses PPP loans that mostly turn into grants, and partially bailing out some of the hardest hit corporate industries with fresh capital injections. It was a much larger stimulus than anything from 2008-2009. The way that the government's accounting works in the current legal structure, is that they have to issue a lot of treasury securities to fund that expenditure. However, the foreign sector was not really buying treasuries, and in fact were selling some treasuries early this year. So, who would be available to buy $3 trillion in extra treasury securities this year? Enter the Fed again. When the treasury market became illiquid in March from foreigners and hedge funds selling treasuries against a backdrop of insufficient buyers, the Fed stepped in, and created $1 trillion in brand new bank reserves out of thin air to buy $1 trillion in treasuries over a 3-week period. This was the most rapid asset purchase program the Fed has ever done. And then they tapered that rate but kept buying treasuries for months to soak up the massive 2020 treasury issuance that funded all the stimulus, and are still buying tens of billions of dollars of treasuries monthly with newly created bank reserves to this day. So, the Fed once again increased its balance sheet, this time by nearly $3 trillion in just 3 months, to buy a large chunk of treasuries, plus some other assets like mortgage-backed securities and a handful of corporate bonds. About $2 trillion, or two-thirds RDS of this 2020 balance sheet expansion so far, consisted of buying treasuries. But what made this one different, was that it didn't just stay in the banking system to recapitalize banks. It flowed through banks to the U.S. Treasury Department, which injected that money directly into the economy as authorized by Congress's CARES Act. This following chart shows the year-over-year change in billions of dollars of total U.S. commercial bank deposits in blue, government transfer payments in green, and the Fed's balance sheet in red. Many people think that the broad money supply is only able to increase when banks lend money and create deposits. However, ironically, the biggest increases in the broad money supply historically happen when things are terrible and so banks aren't lending much. And thus when the money multiplier, broad money divided by base money, is low. At those times, the federal government runs massive fiscal deficits, and goes around the bank lending channel to either tax less from the economy or inject more money into the economy. Historically they choose the latter. And finances its massive deficits by having the Federal Reserve create new bank reserves to buy a large chunk of its treasury debt issuance. This chart highlights that, by showing the money multiplier on the left axis, with federal deficits as a percent of GDP, and year-over-year percent increase in the broad money supply, on the right axis. However, when it comes to investment timing, sometimes focusing on the mechanics is helpful. So, let's dive into some of those mechanics. Bank reserve accounting. Bank reserves, referring to the accounts that commercial banks have with the Federal Reserve, are strange beasts because of how unintuitive they are. In fact, even the very definition of money is subject to debate. There are multiple ways to define money in the modern banking system. The monetary base and the broad money supply are the two most important definitions, so let's quantify them for context. Base money. The monetary base is the foundation, and consists of physical currency in circulation, currently around $2 trillion, and cash reserve deposits that the commercial banking system has with the Fed, currently around $2.8 trillion. Although not part of the original definition, because the Treasury's General Account, TGA, with the Fed has grown in size and importance in recent years, currently $1.7 trillion. We functionally should include that as well, since it's another cash deposit with the Fed. Those three buckets combined are $6.5 trillion in base money. All three of these buckets of base money, currency in circulation, bank reserves with the Fed, and the Treasury's general account with the Fed, are the Fed's biggest liabilities. On the other side of the Fed's ledger, treasuries and mortgage-backed securities represent most of the Fed's assets. If we look at these major Fed liabilities separately, with the TGA in blue, bank reserves in red, and currency in circulation in green, it looks pretty random. However, there's a method to the madness, and the Fed controls the total sum. This next chart shows the sum of those three lines, meaning currency in circulation, commercial bank reserves with the Fed, and the Treasury's general account with the Fed, which are collectively the main liabilities of the Fed, in blue, and shows the Fed's total assets in red, which mostly consists of treasuries and mortgage-backed securities. Bank cash reserves at the Fed are fungible with each other. As folks like you and I use various payment systems to transact with each other, our banks use reserves to settle with each other behind the scenes. Bank reserves are also fungible to some extent with currency in circulation. In fact, that's one of the initial reasons for banks to have reserves in the first place, in case tons of people want to withdraw money at once. In theory, if we all wanted to go and take out some of our bank cash at once, it would come from bank reserves. However, in practice, the amount of minted physical currency is limited, mostly on purpose. So, if there was a bank run, consumers would quickly find themselves limited in how much cash they would physically be allowed to withdraw, as the bank runs out of vault cash. But basically, physical currency and bank reserves are fungible. Bank reserves are fungible with the Treasury General Account as well. When the Treasury issues a lot of bonds and pulls capital into its account, it sucks it out of bank reserves. When it eventually spends down its account, those funds wind up back in bank reserves. Broad money. The broad money supply, on the other hand, is currently $18.8 trillion, which is far larger than the base money amount. This broad money calculation consists of currency in circulation, but then also includes the massive amounts of checking deposits, savings deposits, and various functional cash equivalents that consumers and businesses hold at commercial banks. This is the broader set of money that we consumers actually use to transact with each other and store our capital and define as our money. The blue line below shows the broad money supply. The red line shows commercial bank deposits, and the green line shows physical currency in circulation. The red line and green line added together roughly equal the blue line. When the Fed does QE alone, it increases bank reserves in the system, but doesn't necessarily increase the broad money supply. The broad money supply only increases when either A. Banks create more money by making loans, or B. The federal government runs big fiscal deficits to inject money to people and businesses in the system. Many people miss that second one. They assume that money supply can only increase if banks lend, which isn't correct. Conservation of reserves plus currency plus TGA, base money. For the most part, only the Fed can determine the sum of commercial bank reserves plus currency in circulation plus the Treasury's general account, hereby referred to as base money. Think of these three forms of base money as buckets of water. The total amount of water can move around between the three buckets if we pour one into another, but is conserved within the total three-bucket system. Only the Fed can increase or decrease the total amount of water in the total three-bucket system. The purpose of modern banks is to multiply base money into broad money, and make a profit along the way. We can call this the money multiplier, defined as the broad money supply divided by the base money supply. When a bank makes a loan to someone, it becomes another bank's deposit, and the loaning bank sends the reserve amount to the depositing bank, and increases the total amount of commercial bank deposits and broad money in the system. So, when they loan reserves, banks collectively don't actually reduce total bank reserves in the banking system. They just lever those reserves up with a higher money multiplier, and change the location, ownership of those reserves. Any individual bank can leverage itself, up to a limiting point where it still meets capital and reserve requirements, by lending money or buying securities, and thus reducing its excess cash reserves at the Fed. However, when they make these loans or buy those assets, they create deposits somewhere else in the financial system, and those deposits become reserves of other banks. Similarly, a bank could sell assets and increases its cash reserves, but in doing so, some other bank deposits would be drained to buy those assets, which would reduce reserves somewhere else in the system. Therefore, the banking system as a whole can't decide to collectively increase or decrease the system-wide amount of bank reserves, even though any individual bank can alter its own level of reserves. They can collectively increase the money multiplier, the broad money supply divided by base money, by making more loans or buying more securities, but they can't change the total system-wide bank reserves. They can just move them around, and leverage them up, or deleverage them. Similarly, the U.S. Treasury can determine the size of its general account at the Fed. To increase it, they can issue treasuries, bring in a lot of cash, and then hold the cash in that account at the Fed for a while before spending it. This sucks bank reserves out of the system, on a one-to-one basis with the general account increase. When they eventually reduce the general account by spending more than they take in, that money goes into people's and companies' bank accounts and thus winds up back in bank reserves. The public can theoretically pull money out of excess bank reserves into physical currency, or deposit physical currency into banks, which would wind up as more reserves, like water flowing back and forth between those two buckets of base money. In practice, however, physical currency is limited on purpose, so if the public collectively tries to pull bank reserves out into physical currency, they get told by the bank teller that they can't, because there's a nationwide shortage of physical currency. The Fed, however, can create new base money, and thus add more total water to the three-bucket system analogy, by performing quantitative easing or QE. To do this, they create new bank reserves out of thin air, and then buy existing assets, like treasuries or mortgage-backed securities with those new reserves. After this asset swap, the reserves become owned by a commercial bank, and thus become the Fed's liabilities, and the securities become owned by the Fed, and thus become the Fed's assets. In this process, the Fed increases their total assets, the securities they are buying, and increases their liabilities, the new reserves they are creating, by the same amount.